welcome to another episode of Our Point of View Talk Show. Well, today we are going to be talking about alternative tax-free retirement strategies with Miss Tracy Neal Craddock. How are you doing, Tracy?
I'm good. How's everybody doing?
Pretty good.
Well,
Just wonderful.
Say hello to our hosts. We're going to say hello to retired Captain Eric Jackson. How are you, Cap?
I'm fine. I just slid on in here from my new job. So I'm out of retirement and back working with the fire department and just loving it. So thank you for having me.
Awesome.
I'm glad you're here. And then we have with us Mike Sheely from Sheely Boys Production in the house. What's up, Mike?
What's going on, everybody? Long time no see.
It's been a while, yeah.
Yeah, man.
Thought you didn't like us anymore.
Yeah, man, nothing personal, man. Had to get some stuff in order, you know.
Well, we're going to go ahead and introduce our special guest, Miss Tracy Neal Craddock. How are you doing, Miss Tracy?
I'm doing really well. I'm out here in California, Los Angeles.
Yeah.
Woo! Is that where you are?
No, I'm here, but I'm from there, and I see the sunshine out your window.
Yes. You know, you look, but a couple days ago it was raining, so
I know it was raining when y'all were trying to rescue that dog stuck in the
you
wash.
saw that? Was that crazy? You know, I was like, that dog kept trying to bite. I would have been like, never mind.
You know what, folks were saying? I had one of my partners. I was talking to him, and he said, that dog would just went on right down the wash.
That's the way. Hey, he better get in where he can fit in. Yep.
Awesome.
So Tracy, tell us a little bit about yourself.
So, okay, well, I've been in the financial services industry for 18 years. Wow, I'll back up. So in the very beginning, when I was younger, 18 years old, of course, started going to college, and my major was accounting. But then I learned real quick. I mean, I love numbers, but it was so boring. So I said, okay, let me try to do something, you know, where I know I can make great money. And I ended up going into sales for years. And then when I've sold copiers, I've sold, I always tell people jokingly, I'm like, I sold people too, but I was a legal recruiter. So
I was about to say.
I know.
Long day and age, talk about selling people.
Hey, I have a friend who she's a pharmaceutical salesperson, and she always used to joke, you know, she was, and she said, you know, I was a legal drug dealer. So, you know, whatever.
Lord.
But so anyway, you know, I was a legal recruiter, and then when 9/11 hit, you know, everything else stopped.
Right.
And I said, okay, you know, got laid off, and I said, the next move I want to make is in an industry where it doesn't matter what happens. You know, I can still make money and I can still help people. So I went into the financial services industry a little time after that, and been in the financial services industry for the last 18 years. And maybe the last 12 years, you know, got my license, and you know, the rest has been history. I've been on this road, and you know, I just felt like what we're talking about today, I wanted to, I just want to share with everybody. You know, all my clients I share it with all the time, but just going on a bigger level, because for me, after, you know, the Floyd incident and Black Lives Matter, us sitting at home, it made me think about how much as people of color, if we knew better, we'd do better, and how much we don't know of things that are there available for us, you know, but we just haven't been taught. So that's pretty much where I am now, and that's my mission. So, so yeah.
Now, how long have you been in? Have you always been in California?
Born and raised in Inglewood.
Okay.
Oh, I'm sorry.
West
I'm sorry.
Side.
I'm sorry. I'm sorry, Jacqueline. I didn't mean she said Inglewood.
No, that's, you know what? Everybody does that. That's okay. It's all good.
You know,
yeah.
Jack, let me just say this real quick. So I was home visiting my mom, and so there was a shred event that they were having at Inglewood High School.
Mhm.
So I got in line, but you had to be an Inglewood resident
Of
to
course.
do the shred.
Yep.
I didn't know. Well, they said it on KJLH. So I got there and pulled up to the lady. I had 3 boxes of stuff, and she said, "Sir, ID." And I pulled out my Georgia ID, and she looked at it, and I said, "Listen, I came all the way out here from Georgia to do this shred event, and you trying to tell me you're not gonna take my stuff in the back?"
She said,
She
no.
was she started getting on the phone. She's like, and she was like, "Nah, can't be." And so my partner, who lives up the street in those townhomes up the street from the forum,
Mhm.
she's looking and she's going, "Don't believe him. Don't believe him. Don't go for that." So just my little quick story.
That's funny.
Good.
Okay,
See,
Jack, I'm sorry.
I know exactly where you were because they always do the shredding events.
Oh, okay. Okay.
Mhm.
Okay.
Funny area. Well, we're going to start talking about the alternative tax-free retirement strategy. So Tracy, tell us a little bit about that. What is it?
So the alternative tax-free retirement strategy, putting money into a vehicle, right? That's earning interest. And when you take it out, it's tax-free. And people say, well, that's nothing new. You can do that with a Roth IRA, right? But you can. But then you have rules to those Roth type of vehicles, those Roth IRAs and all that. And we'll go into that in more detail. But with what we're going to be talking about is you don't have those 59.5 rules where, you'll get penalized if you pull it out. You know what I mean? You don't have
Mhm.
that. You don't have the rules of, if you're over 50, you can only put in $7,000 a year. You don't have that.
Right.
So this is a completely different type of vehicle that has, if you believe it or not, it's been around over 120 years. It's just they don't talk about it.
Mm.
Yeah. So we'll get into a little bit more in detail because think about it. The bottom line is with tax-free retirement, we know 9 times out of 10, the taxes are going to be going up in the future. We can bet on that, especially since this pandemic has come around. They need money. They're going to need more money. They got to pay for all these stimulus packets and PPP loans or whatever, right? So they're going to take it from somewhere. And usually it's middle America that they take it from. The wealthy already know where the tax-free strategies are.
Right.
It's getting it out to the common man and small businesses.
Mm-hmm.
So when should you start planning for it?
You said, when should you?
Yeah, at what age?
I say with any type of planning for retirement, the earlier, the better. You know what I mean? So, there's, it will be great for somebody that's just going into the workforce to start it. But how about this? What if I told you as a parent, when your kid is born, you can start them then? Oh, okay.
Well, I did it with the educational fund.
With like a 529 plan?
Bam.
Okay. So yeah, and that's great. But again, you got rules to that 529 plan, right?
Yep.
If your kid doesn't go to college, what happens? How many
You can't
kids you
use
got?
it.
How many
2.
kids you got? 2? Okay,
two
so
more.
then if the first one doesn't go to college and they want to go to a trade school or culinary art school or something like culinary art school, it's not paying for that. So then you gotta keep hope alive and hope the second one can do it,
Yeah.
But if they don't, guess where that money goes? Back into your retirement. If you're not 59.5, they're going to penalize you 10%. Uh-huh.
So it
Yep.
doesn't
For real?
pay for secondary
Yes.
post-education?
Not if they're
It has
if
to be
the
college?
kids, it has to be college. That's
Yeah.
how it's set up. It has to be college. Yeah. So they'll say it went back and wasn't used for its intended purposes. Then it has to go back into your retirement. It can pass to another kid, But let's just say both kids didn't go to college. It wasn't used for what the purpose was. It was supposed to be for. So it goes back into your retirement. And if you're younger than 59 and a half, you will pay penalty for that. Because you were able to save it up tax deferred.
Oh, okay, you already know what I was getting ready to ask you.
Mhm.
Okay.
Yeah. So, or actually, well, I don't know if it was tax deferred. Sometimes, well, it depends. Sometimes it's after tax dollars, but it's still, the Uncle Sam is gonna be like, I want my taxes, because I'm letting you take this money out tax-free,
Right.
when they get into college. But if they don't go to college, you have grown all this money, interest, with interest, and
Mhm.
you think, Uncle Sam's like, you think I'm not gonna get no money off this? No.
Right.
So there's rules, and there's rules to all of them. So with that being said, think about, do you guys know the different places that the IRS really lets you put your money? Like there's kind of like buckets. You guys ever heard about that? Like 3 different buckets.
No.
So
Not by the term buckets, but
okay,
You mean like
so you might have.
ETFs?
What'd you say?
Do you mean like ETFs and CDs and bonds and whatnot?
So, well, stocks, yeah, ETFs, but so let's just say the first bucket is we could put our money in a savings account, checking account, mutual funds, right?
okay.
Money markets. So this bucket is like a tax me now. This is if I earn anything over $8, I'm gonna get a 1099 at the end of the year, and I gotta pay taxes on that money. Mutual funds
Okay.
included, right?
Right.
CDs, that kind of thing. The other bucket, the second one, let's say that's a tax deferred bucket. So you would know that you said you were a retired captain, right? So you guys have
Yes.
457s, right?
Yes.
Okay. For corporate America, 401ks, for
Right.
teachers, 403bs, you got the IRAs, traditional IRAs,
Right.
in that bucket. So, there's rules. Touch any of this money before 59 and a half, you're going to have a 10% penalty. But then there's also a 72-year-old rule. Whereas what if you didn't need that money for retirement and you were good? Like you have a pension, Eric. So what if you didn't need that money? Well, the government says, the IRS says, well, at 72, we don't care if you need it or not. You're going to start taking required minimum distributions because I've allowed you to save this money up tax deferred all these years. And now I want my money. That's it, right?
Mhm.
If you did not take those required minimum distributions that the IRS wants you to make, they can go in and snatch out 50% of the money that's in there.
So like with my, and I use me as an example, because I seem to be what you're speaking of, the scenario wise. So I'm getting my pension, and the monies that I had in my 457, once I left the county, well, actually, they're still in there.
Yeah.
But there's no accumulation. It's not growing,
Well,
at least not yet anyway, because it's growing based
Yeah.
on the choices that I made with those.
But you're not contributing to it anymore.
Right.
Mhm.
Right. So right now it's cool. Now,
Yeah.
if I wanted to move it over like to a Roth or to something like that, just so long as I'm not taking anything, I was advised I would not be penalized.
Is it a Roth? Is it in a Roth now?
No, it's just in
The 429,
correct.
I mean
The four-
457 plan,
Yes, it's just there.
like a deferred comp plan.
That's it.
Okay, so in that scenario, if you moved it over to a Roth, you will not be penalized. But you know what would happen? Whatever money's in there, because it's been growing tax deferred,
Uh-huh.
you will pay the taxes on it if you throw it into a Roth. If you want to convert, because that's a conversion. That's a whole nother topic. And me and you can have a sidebar when we get done.
We
So we're
will.
not putting all your business out there.
Right.
You get what I'm saying?
Yeah.
So you're right. You won't be penalized, but you will pay taxes on it because it's coming out of one bucket. And that's my segue into the third bucket,
Okay.
which is tax me never. So you got your Roth IRA.
Mm-hmm.
Roths are over in the tax me never column because the
Mhm.
money's going in is after tax dollars, right?
Okay.
So that means when you take it out, you don't pay taxes on it. But there's still
Right.
rules to that too. The 529 plan that you talked about for your kids, that's in that side too. And we talked about that. So I'm not going to go over that again. As long as you use it for college, it's tax-free.
Right.
There's also municipal bonds. You might earn a little bit of interest in that. That's to help the government, fix the potholes, the highways, the byways, that kind of stuff. You take that money out as tax-free. But this last one that we're really going to be focused on and talking about is something called an IUL, Index Universal Life. It's a life insurance policy. And so if you look up the IRS code or IRC code 7702A, anything attached to life insurance really is tax-free when you take it out.
You said
So
77 what?
7702A. There's an A, there's a C, but 7702, you can just look that up.
Okay.
There's a lot though, so just take your time and read it. So that's what we're going to be talking about, utilizing this as a tax-free retirement strategy, because what we've been taught over the years, I know my parents have been taught this and everything. I don't know if you guys remember, I don't, but I don't think any of us are old enough to remember, but I remember people talking about how the insurance guy would come to the house and pick up money, right? Every single month, right? And we were always taught that, first of all, in the Black community, they didn't even allow our parents to get that much insurance versus other community.
Mm-hmm.
And second of all, it was only there for death. It was strictly there, just you're just going to use this to, we were always told that this is for when you die. But life insurance, really, honestly, it was invented to create tax-free income stream off of it and leverage your money. It was created for that. They actually, slave owners actually had life insurance on slaves.
Mm-hmm.
A lot of people don't know that, but they did.
Mm-hmm.
And they made a lot of money off of that too. So that's why they could do whatever they wanted to a slave and nothing would happen to them, because they were always made whole or given more money to go buy more. You know what I'm saying?
Mm.
So it was always there. It earns interest. When you take it out, it's tax-free. So you have two different sides to this coin. You have, of course, the death benefit of this policy, right?
Mm-hmm.
But the part that we can use today, because we're assuming we're living longer, is the cash value side of it. And that cash value side, every time you put money into that life insurance policy, so let's say you had, hypothetically, $200 going into this life insurance policy. $50 would probably be going over to pay for the insurance, right? But $150 is going over to this cash side every single month. And it's earning interest for about 6.5% to 7%. I'm gonna ask you, what are you getting in your savings account today? Anybody check?
Probably like
How much money
2.5.
are you making in your savings account?
Probably like a 2.5 APY, probably.
And you must have an online bank.
Mm-hmm.
Okay, millennial. Right. And that's really high. If you walk into any of the regular banks that are not just online banks,
Right.
how much you guys earning on your savings?
Like 0.08% probably.
Right. Right. So think about that. Where's inflation right now? You guys know where that is?
It's extremely high. It's extremely high.
It's super high.
Extreme-
Before the pandemic, it was 3%. They just talked about it 2 weeks ago on TV and it's at 7%.
Mm.
That's the inflation that we just had. So how are we supposed to keep up with inflation? And people are putting their money in savings accounts, or they're putting their money in saving it tax deferred in their 401k, right? But if the market crashes again, what happens?
Ooh.
Everything goes with the market.
Yeah. So in 2008, I was working at a credit union, and when the market crashed and went almost 50%, right?
Ooh.
It was like
2008.
48%. So let's just say 50%. There was one of my clients was gonna retire. He
Hmm.
wasn't my client, he was a client of the credit union. He was gonna retire. Maybe whenever it happened, he was retiring that December or something like that. He had to wait another 3.5, 4 years.
Mm.
And he still didn't get the money that he lost. But he was just like, I'm done. You know what I mean? So in this vehicle, you never lose a dime of that money that's in there. So when the market goes up, you get some of the gains. You know, the insurance company is not going to give you the full market gains because
Right.
they're taking the risk. But you probably get up to 10%. When the market crashes, you just don't earn anything, but you don't lose either.
Mm.
So if you think about, if you can picture in your head, we're going to say how the market works versus how this index universal life product, IUL, works.
Mm.
With the market, if you had $1 million, and let's use the scenario of 2008, the market crashed 50%. How much money do you have? You started with
Ooh.
$1 million. How much money do you have?
500,000.
500,000.
Right, 500,000.
Oh,
But they'll tell you, oh, don't worry about it. Keep your money here. The market will go up again. Okay, well, let's just say, yay, we saw the market go up 50% again. How much money do we have?
Now you have your original million back.
No, you don't.
Wait, no, you only have 750,000 because you lost 250,000.
There you
Yeah.
go. Are you happy?
No, you just lost $250,000.
Exactly. So let's, oh, go ahead.
That's why I haven't been right ever since. Because I never recovered from that.
Most people haven't. They haven't. But this is where they tell us to put all of our money, right?
Right.
Okay,
Now,
so
what about
let's, well, let's
go ahead.
look, before, hold that question. Let's flip it now. We're
Okay.
now having our $1 million
Mhm.
and it's in an index product.
Okay.
So we got this $1 million. Remember, the cap on it is 10%, right? So no matter how much the market goes up, this is only going to earn 10%, okay?
Mhm.
But you remember, you're not losing any money, right? You
Okay.
got that?
Yes.
Mhm.
So we all start out with our $1 million. Oops, the market crashed 50%. How much money do we have?
500,000.
Wrong.
You just said you started with $1 million, it crashed, lost 50, half of $1 million.
You have it in the indexed account. What else did I
Oh.
say about it?
Oh,
You don't lose a dime when the market
Oh.
goes down.
Mm-mm.
So you got $1 million. The market went down 50%. What do you have?
$1 million.
1 million.
You
Oh.
got your million.
Mhm.
The market went up 50%. Remember, this one, you're only going to cap at 10% more. So how much money do you have now?
1.1 million.
There you go.
Mm-hmm.
See the difference?
Mm-hmm.
Are you happy?
Yeah, you just made
You're
it.
not pissed off like you
5,000.
still are over there on the other side, right?
Right.
I can see you're bitter. So
I'm blessed. I'm blessed.
yes,
But
absolutely.
because my job doesn't even have a pension anymore. Now it's they got rid of the pensions,
Mhm.
and now they're doing some modified 401k. Ugh.
Mm,
We can't
Yeah.
even keep people because there's no more pensions, but no
Right.
one's working that long.
mhm. And they don't want to be responsible for paying because people have been living too long. You know,
Right.
you're supposed to die at 67 and you
Right.
start taking it at 65. But we see that people are living in their 90s. So they don't want to be responsible for that anymore. Yep. So
You're talking about this is on the life insurance policy. Okay, now what type of insurance policy do you need to have? Do you need to have a term or do you need to have a full life? Or
so no,
maybe
term, you would never see any of this because term is like renting insurance.
20
So
years? Okay.
what I do is I sit down with people, find out what their goals are, when they want to retire, and we put a strategy in place. So term insurance is just like renting insurance. It's like renting an apartment. You will never be able to pull any cash value from that. You'll never be able to do any of that because you don't own it, you're renting it. That's why they're so cheap.
Okay.
You banking on you dying, they banking on you living
Right.
and outliving the policy. And 99% of the people outlive the policy. So that's why it's so cheap. They never really hardly have to pay those out. So permanent is always better. Now, whether it's whole life, universal life, or index universal life, that is a time where we'll sit down and we strategize to see, based on your goals, which way is the better option to go. And not just that, but you got to build it right. Because if it's built the wrong way, it's not going to work.
Yeah.
But you can actually take out of these index universal life products, you can take a lifetime income stream tax-free for the rest of your life. I've seen people put in $100 and some thousand and that's it off of it. Let it sit there. And they're taking these income streams off of it for the rest of their life. And just like with a pension, you put your money in this pool with everybody else, right? And then they give you, when you retire, they give you a certain monthly amount stipend for the rest of your life. Well, you might have only put into that pool $200,000,
Mhm.
but in 5 years, your income, you know, what you're getting back, you might have already gotten that $200,000 back, but they got to still keep paying you for the rest of your life, right?
Mm.
That's the same thing that happens over here, life insurance product. But the difference is it's yours. You own it. You decide what to do with it. We can create it where you can decide, I want to take this much amount out. We can do that for the rest of your life, tax-free. So when you're looking at, go ahead.
I'm sorry, but when can you start taking it?
Well, we set that up. So I always tell people, this is not a 2 or 3 year product. This is at least 10 years.
Okay.
So I can build it however you want it. But of course, if you said, I want to start taking lifetime income for the rest of my life in 3 years, well, yeah, it's going to be expensive for you to put some money in. But if you can have some time for it to grow and then want to take it out, take some money out in about 10 years, it will allow you to do that for the rest of your life.
It's the
So
long game.
This needs to start being built around in your 30s or 40s. So
Oh,
by the
Ooh.
time you get to maybe even 20s.
20s, 30s, 40s. I have somebody who's 50. She started hers. She's not retiring until 65.
Yeah.
That's 15 years.
That's 15 years.
But shucks, the earlier the better, right?
Oh, I can't hear you. Go ahead, Eric.
I said, but the earlier the better though, right?
Absolutely. Because if you think about the earlier the better is, the younger you are when you start something, the less money you have to put in,
Right.
you know, because you have more time to have time on your side to help it to grow.
And you said this is a whole life policy, right?
It's a permanent policy.
Permanent.
Permanent. All right.
Permanent.
And what companies would you recommend that have the best permanent policies?
I mean, it's a lot of them because a lot of them been around for years. National Life Group is one of them, but I'm not doing a commercial for them yet, so I don't really want to. They're not paying me like that.
Right.
They're not sponsoring this. So, but yeah, they're one of them. And definitely, and like I said, when we sit down on one-on-one and we talk, we could talk about all that, you know. And a lot of people haven't heard about this. They talk about 401ks all the time and being in the market. We're gambling with our money.
Mhm.
because we feel like that's the only option that we have.
Mhm.
And it's not the only option, you know?
Now, is it good to have just one policy like that? Because you know how like your credit unions will send you life insurance policies, or AAA
Mhm.
will send it to you, or
Mhm.
AARP. You know, they're little policies. So is it best to have just one big policy and just pay the
Um,
bigger amount, or just get these little policies?
Not those little teeny tiny ones, because usually the ones that you get from like AARP or something like that, um, to me, those are more so for people who have medical issues that can't really get, because you got to qualify for it. You do.
Mhm.
You can have high blood pressure, you can have diabetes, you can have all that stuff. They don't care about that as long as it's controlled, right?
Yeah.
But we're talking usually AARP and stuff like that. Their policies are geared more towards people that have serious illnesses that probably couldn't qualify for a regular insurance policy.
Now
So it
is
depends on, to answer your question, I'll get to you in a second.
okay.
It'll depend on how many assets you have, because and what you want to do with retirement. So if it's a little bit of both, might recommend you have two.
Okay.
But one you're going to use as a life insurance policy, like God forbid something happens, is for your final
Mhm.
arrangements. And
Mhm.
then one part of it you use to borrow from for retirement.
Mhm.
And that's the
can.
same policy. You can use the same policy for both. Or do you have to get two
You,
separate policies?
I would recommend in that scenario, you get two different policies.
Okay.
However, with the policy, there's a third piece to that too. So if you got sick, like say if you had a heart attack or you had a stroke or you got cancer. I mean, how many of us know people that have had cancer, right? But they haven't died.
Right.
A lot more people are living, right?
Right.
So if you had one of these policies and you ended up getting cancer, let's say you're just in stage 1 or stage 2, you're not going to die from it, but you're sick,
Right.
they will pay you a lump sum of money. So you can do with that whatever you want. There's one girl that I know, she ended up 2 years after she got the policy, she had a lump on her breast, found out it was cancer. She was young, 28 years old.
Wow.
And they gave her a lump sum of money. And you know what she did? She quit her job. She did her chemo and stuff. She quit her job, and she always wanted to be a baker. So she opened up a bakery.
Mm.
It's your money. You can do what you want with it.
So that's
But
in
it's
the
there for,
policy. That's in the
that's
policy
all in the
for how much
policy.
you're gonna get.
Yep.
Okay.
They spell it out. They show you. Mhm.
And that's for what type of plan? That's a permanent?
That's a permanent policy. And not all of them are the same.
Is a universal life policy the same as a permanent policy?
It is a permanent policy.
Okay.
Yeah. So there's like usually three different types of, typically it's either universal life, index universal life, or whole life.
Mhm.
But they're all permanent policies.
Okay.
Mhm. Yep.
And which
And
one
it's
would
just
you
a concept.
recommend?
Go ahead.
Between the whole life and the universal life, which one would you recommend best?
I'd have to sit down with you and talk.
Okay.
Yeah. That's one of those things where, we got to find out what you want to do.
Okay. Okay.
Yeah.
All
Yeah.
right.
So you can create it however you want to create it.
Mhm.
That's why I sit down with people and I we set goals. It's like, what do you want to do? How much money do you want to have from this policy versus your pension and your 401k or whatever? We know that that's coming in. Let's see what we can do there, but
So
what, you really want to go ahead.
I was gonna say, so using that example with Mike, I believe, Mike, you're still in your 20s, right?
Yes, I'm 26.
So with Mike being in his 20s and me being 53, and we're talking retirement talk, then is it fair to say that that conversation might be a little bit more aggressive or conservative versus the conversation with him where it may be a little bit more liberal? And
No, the conversation will be different because yes, he is, you know, he has his age working for him.
Right.
We have ours working against us,
I'll be
you know, with the time, you know, because we
Right.
don't have as much time as him to have this money
Yeah.
grow.
right.
So like so for example, with him, he might have to only save up and stop saving at 50 years old and let whatever money's in there just keep earning interest until he's 62 or 63 or whatever, until he's ready to take from it, right? We got to
Right.
keep putting money in
Right.
at our age because, you know, we're trying to build it up faster.
Mm-hmm.
Mhm.
So is there a minimum that you have to put in, or can you like set your own limits?
You
Can
can set
you-
your own limits. I mean, usually the minimum is like $50.
Okay.
And that's
then,
why I
is there a
say
maximum?
oh, well, it depends on how big you want that policy. You know, there's a lot of
Right.
policies out there. So I mean,
Right.
I'm talking to somebody right now. She is probably going to be putting in $70,000 a year.
That's good money.
She's 40. She wants to retire at 55. But she makes decent money, you
Right.
know. She's a business owner. She can
And,
do
s-
that.
and see, Mike, man, when I was in the department, we had guys, just to show you the difference or the gap, we had some firefighters that didn't quite look like us,
Mhm.
that were maxing out.
Mhm.
They were maxing out. So
Before
basically,
their retirement, is that what you're talking about?
yes.
Mhm.
So as far as maxing out, as far as what was going into deferred comp, so they could afford to just about dump their entire check, you know, minus everything that's coming out, but pretty much dump their entire check into deferred comp because they already had money on the back end, you know, either because, you know, families or and wealth that had been
Yep,
passed along to
inheritance.
them. Yeah.
Inheritance. So think about the Rockefellers. You guys remember the Rockefellers, right?
Yeah.
You remember hearing about Vanderbilt's?
Mm-hmm.
Mm-hmm.
Who got money still?
Both of them.
No, they didn't.
Who
The
lost the money?
Rockefellers forgot
You-
they got theirs.
Rockefellers had their money. The
The
Vanderbilts,
Vanderbilts lost the money?
they lost their money. Both of them had the money at the same time. But it's because the Rockefellers did something completely different. And they set their life insurance up properly. And their money still pays them to this day. They have a whole account thing set up. And I will probably go into that if, you know, I get invited back. That's a whole nother.
We can
That's a
extend
whole
this
nother
show
thing.
right here.
The Vanderbilts don't have their money anymore because every time somebody died, they gave their money they split it up, you know, to the
Charities.
the beneficiary, no, the
The
beneficiary. So their
okay.
kids or grandkids got money, but basically they squandered it away.
They didn't put it back in the system so that they can set up for their life insurance.
Did not. You know who took the one who took her money, basically? Gloria Vanderbilt. Remember Gloria Vanderbilt jeans? You might not, because
Yep.
you're 26.
Yeah, you
Yep.
We
Yep.
remember
the blue jeans.
with the little
Glo-
swan on the back.
Gloria Vanderbilt, Jordache, all them.
Right. So Gloria Vanderbilt, who became a designer, she
Mhm.
built an empire on her own with her money. Her son is Anderson Cooper.
The Anchorman.
Right.
Yeah.
So
Yeah.
Anderson Cooper, he's talked about it on his show. He was like, we ain't got no money. I have money because of my mother.
Yep.
And so here's the thing. If you don't, you know, this whole thing that I'm talking about is about creating a legacy. And you will be able to set yourself up, your kids up, even on ways that if you want to set something in place for them to be able to own a business, take some of that money out of that cash value, borrow from that, and pay it back instead of borrowing from the bank, right?
Mm-hmm.
You ain't never gonna see no money back when you're paying the bank back. They're not putting the money back into your savings account. They're pocketing the money. That's what they're doing. So you can actually, that's another topic. You can borrow from it and pay yourself back too with interest.
Yeah.
Can we go in that topic for like the last 20 minutes? Can we dive in a little deeper over there? That sounds real.
I know that's interesting to you. Yeah, we can talk about it.
Okay. So just about the whole basic like procedure and whatnot, like
So you mean like how does it work?
How do
yes.
you set it up?
It's all in how you set everything up. So like what I told you what the Vanderbilts did, the Rockefellers actually basically pooled their money together.
Mhm.
And in doing that, they have a whole team of people that they set up. And there's rules to this. So none of the beneficiaries of any of this, if you don't have these certain parameters in place, don't come here asking us for no money. We're not giving it to you.
Yeah.
Mhm.
But it's here for you if you want to start a business, but you got to do this in return. It's
Yep.
here for you if you do XYZ 1, 2, 3. You know, they set that up. And that's something that I'm going to talk about more in detail the next time, because if you set it up that way, you can utilize this as basically your own, you can become your own bank.
Mm.
You can become
Michael,
your own bank.
he's all into it.
I'm telling you, you
He's
can.
about the numbers. He's about making the money.
Because think about it, if you had $40,000 in that cash side and you needed to buy a car, why not take it from your bank? You pay yourself back
Hey,
with interest,
Yeah.
Mhm.
right? So you're not only paying you. So what you do is you ask the insurance company, you say, you know, I want to take out 30,000 because I'm going to buy this car. Okay, we'll send you a check, 2 days. No, I need it tomorrow. Okay, well, you'll pay $25 or whatever to get the check to you the next day. Then so they let you borrow the money. Your cash value is still in there growing.
Mm.
You pay back the money. As you're paying it back, you're paying it back interest, maybe 4%, right?
Mhm.
But remember, averages about 7.5%. But let's just say this year, the market did great and you get 10%. You still got 6% dropped into your cash bucket side over there. That's still growing.
Mm.
You have become the bank.
Okay. And is this something that to get it started, would you set up like a requiring transaction from like a work check until you get to a certain
It'll
amount?
come from your bank account.
Oh, all right. So you can set up direct deposits strictly into the account. And then like is all of it on like a mobile app too, so that you can see what's in it and
Yeah.
like okay.
Mhm. But remember, because you had mentioned EFT, I'm assuming that you play around with the stock market.
Yes,
Play around.
I use that lightly.
Yeah, it's every day, 24/7.
Okay, so
yeah.
think about when it comes to the stock market, because it does change daily.
Mhm.
You can see your money on a daily basis going up or down or whatever, right?
Right.
When you're talking about indexed accounts, always remember they're not in the market, they mirror the market.
Right.
So you're not going to see it going up and down like that. There's point to points. So it's like you won't see the crediting for probably a year. Even though it's doing something in there, you still won't see it for a year
Okay.
because it's not in the market.
Okay. Okay.
But
But
you
you
won't
can
lose any money.
still log in and look at your stuff if you want to or whatever. It doesn't matter
Okay.
on your phone. Yeah.
But you don't lose the money, but you only gain.
Never lose a dime.
Mm.
Okay.
I don't put people with anything that they can lose the money. That's just not my thing.
Mhm. So this is something that should be started for, a child, for like a newborn. You should
I
start it
think
young.
so. That's what they do. So let me tell you a story. So when I was working at the credit union out here, and this is before I even got in this business. So I was doing home equity loans and stuff like that, right? So occasionally I'd see 25-year-olds just graduated from college, about to get married. They come in there with checks from the insurance company, $250,000. $280,000, $175,000. And I'm like, oh, wow. This is where my mind went. I was like, dang, somebody died. That's so sad. So one time I asked the girl, I said, did somebody pass away? She's like, oh no. No, my parents gave me that. So I'm still not understanding because I didn't want to get in her business, right? Because I didn't know anything about that. So then after I got into business, light bulb came on, ding, ding, ding. Her parents got that for her when she was a baby. And they max funded it. And it probably paid for her college. Probably paid for, and it was paying for her a down payment on a house.
So they come out of college
With money.
with no debt,
No doubt.
money,
What's that?
either with a house, something obviously that has equity or has some value, or they come out with a clean slate that they can dump, in order for them to start.
Yeah.
See, that's what
Start
we're
their
missing
life.
from our community.
Exactly. And that's why I want to do it. That's why I'm doing this. Because to me, when I figured that out, now, after I got into business and started learning more about it, I was like, oh my gosh, this is what their parents did for them. They set them up. But see, we were never taught that. They were always taught to leverage your money. We were never taught that. So how are we going to know? The only thing we knew was that they're coming around to us telling us, our parents, they can only get $20,000 or $25,000, and that's for their death. When they're over here getting multi-million-dollar policies and dumping stuff in it, because why? They're earning more money in that savings part and the cash value side. If you're earning 6.5% to 7%, that stuff is growing when you're maximizing that cash value bucket. Because remember, insurance only costs this much.
Yeah.
Right.
Everything else was going into that cash value side of that life insurance.
Yep.
And that's how they have kept it like this. So we have to get educated for it to level the playing field, or, and it might not happen. I always say this, it might not happen necessarily in our lifetime. We're the ones to set it up. But you're going to be the great granddaddy that they have on their mantle. This is what my great granddaddy did for me. This is what my granddaddy did for me. I best believe, and one of them Rockefeller's homes was the original Rockefeller who started that business.
John D. Rockefeller.
John Rockefeller, who started it. Guaranteed they got a picture of him in their house, in their homes.
No, that's right.
Weren't they pioneers in like the railroad industry?
It was either railroad. I know it was steel. Yeah,
Steel.
I know.
I was gonna say it was steel.
Mhm.
Yeah, okay.
Yep. So, my thing is we're conditioned to put our money in the bank that doesn't earn us anything. Because even though yours earns more, what's your name again?
Mike.
Even though your bank earns more, it's still underneath where
7%.
well, it's at 2 something. It's not
2%.
keeping up with inflation, but it's giving you more than what the regular banks do, but it's still not keeping up with inflation. So, but that's how we've been taught. Go on, save your money, put it in the bank.
Why?
And so that's what we know to do, but that's a poor person's mentality to do. It's nothing wrong with putting money in the bank, that all your savings and stuff like that shouldn't be over there. Leverage your money and put it somewhere else where it can grow.
Make your money work for you.
Right. Because you know that you're making your money work for you in doing your day trading or whatever you do.
Right.
But then I'm sure you have liquid money,
Yes.
that you have. And here's the thing. Donald Trump, back in the day, way back before all this presidency stuff, he filed bankruptcy, right? This was back in what, 90s? He had to file bankruptcy. He was broke, but guess how he got back on top?
Life insurance.
Life insurance. He went to Viatical settlement companies, sold his life insurance. They gave him a certain percentage. He got right back on top. Because once you know how to make money, you can make money again if you lose it.
Exactly.
Wow.
So that's what he did. O.J. Simpson. Remember when Ron Goldman's daddy got on TV talking about he got money, he got money.
Mm-hmm.
He did have money. Guess where he was putting it?
Life insurance.
His children's name,
No, life insurance.
life insurance.
His money is in life insurance. While his butt was sitting in jail in Las Vegas, he was still earning money.
You'll make it
Cause-
And
long.
they can't touch it.
They couldn't touch his pension either, I don't believe.
Nope, they couldn't touch his pension and they couldn't touch the life insurance money. It's illegal.
And they just over there just hot, just mad.
Right.
So if you were ever trying to hide any money from like the government, you
There is no hiding unless you go out of the country.
And even
Offshore
then
account.
they watching.
Yeah,
so
going over to the
life
Cayman
insurance
Islands or somewhere
Mhm.
else.
It's just a better way of storing your capital, not hiding it. You're storing it.
Yes, it's a smarter way because you can also use that cash value in that side when it's time for you to buy a house.
Mm.
You can utilize, even if you don't take the money out of there, because you might already have money to put down on a house, you can utilize that cash value in there for your liquid money. Because
Right.
they're gonna ask you how much you have liquid. That's in there. Do you have cash value in the life insurance? That's one of the questions.
Mhm.
And that helps you out.
And when you set up your life insurance policy with whatever company you use, you can sign on to their mobile app and they'll have like a cash value section and then they'll have like
Yes.
regular section so you can see
Yes.
those numbers. Okay.
Mhm. And you can choose what indexes you want to put them in. There's
Okay.
different ones. There's some that have to do with AI,
Mhm.
artificial intelligence.
That would be the best investment right about now because the future of artificial intelligence
Right.
is big.
But commodities is always good too, because we always need that.
Right, that too. And then I feel like your blue chips, like your Dow Jones, that'll never go anywhere. So
No, it doesn't. But it fluctuates too. But yeah, you got equities in them. You can, you can utilize different indexes depending on what you're trying to do,
right. Okay.
or what you feel comfortable with, and you can always change them.
Tracy, I think I shared a story with you earlier about when my older two children were younger. I had a girlfriend of mine's mom. She used to sell insurance, and she
Mhm.
came to me and she we started an insurance policy. But
Mhm.
back then they were 4 and 6, and I didn't understand about the insurance policy, whether it was a term or whether it was life, and whether it had a cash value to it or whether it was just a life insurance policy. But back in the day but that was like back in the 80s.
Mhm.
So if I would have known
Mhm.
then what I know now,
Yeah.
they could have really been sitting
Oh, they
on
would have been set up.
Yeah.
I have a client who does what is it called? I mean, he has the green room and all that, so he would have
Pro-
stuff like this, right?
Production.
Yeah, he does production. And so his mother set him up. So he understood it where I didn't have to explain because he's reaped the benefits from it and he's been able to put down payment on a house over there, and Eric will know this, in View Park.
That's where my grandmama lived.
Grandmama. But yeah, but those houses are not, they're more expensive,
Yes,
in the
they
heart of
are.
LA.
Yep.
Very nice area. But his mother set him up when he was a kid.
Mhm.
And so he just did this and dropped $50,000 in his son. His son is, about 5. He dropped 50,000. He said, I don't even want to think about it. I just want to drop 50,000 in there. And you can do that. And he said, and we set it up. I created it to where it's a one-time payment. It's completely paid up. And his son will have, just imagine $50,000 sitting in somewhere growing for, his son is 5. Till he's like 55, 60 years old. Can you imagine?
See, that's the long game.
Mhm.
That's what I'm saying. So he's going to have money for college, if he needs it. He's
Right.
also going to have money, if he doesn't need it, definitely to put down on a house. If not, investment opportunities, whatever.
So if he
But
doesn't
he-
go to college, can he still use it?
Absolutely. This is
Okay.
your money.
Okay.
Right.
You don't have those rules.
It's just
Those
growing
rules are not in
interest.
place.
Your money's just growing interest. That's it.
And you can take it out whenever you want. So your son, or your son being, however old he is now, I mean, if you had that policy, he could take it out now. You don't have to wait till he's 59 and a half. No way.
And,
He's
and, Ja-
42. Can you imagine?
and
I
Jackie,
can't.
I can tell you those homes over there in View Park,
Beautiful.
don't,
It's where Ray Charles, so you know that movie Ray?
Mm.
One
it's
of the
right up the street
houses,
up
that
there near
last
Windsor
house
Hills
that
Elementary.
they, right. Did you go there?
No, my brother did.
Okay. So, right, that's where Ray Charles, where they filmed that. That was one of the last house I think he might have been in.
Yep, it was.
On that movie. And they used the real house.
My play sister stays right 2 houses and directly across the street from it.
Okay.
Yeah,
I
you-
used to walk over in that neighborhood, because I lived in Inglewood, and I used to drive my car over there and walk, because it's just a beautiful neighborhood,
Right.
and you
It's-
see all these beautiful Black folks.
That's all there is up there. I mean, well,
Not no more.
no.
That's a whole nother.
Jackie, your friends are moved in.
That's a whole
Hmm.
nother show.
Mhm.
But those homes over there are nothing less than $1 million. But
Oh, I mean,
it's
you're right.
California anyway, right? So you already know it's going to be expensive. But I mean,
yeah,
they're
but
really
they're so expensive now. I mean, my friend that lived in Inglewood, she fixed her house up because her dad passed away, and she sold her house for like over $1 million in
Mm.
Inglewood. That wasn't
Now-
even heard of.
you're still in Inglewood, right?
No, I live in San Pedro now, right by Cabrillo Beach. I'm by the beach.
Jackie, don't even entertain that. Don't.
I'm serious. What? Just saying.
I'm not saying that. Cabrillo Beach is nice.
I mean,
I remember.
it's not.
remember
It's
going
not
there as a-
Manhattan Beach, but
No, but it's not. Cabrillo Beach is not bad. San Pedro, that's not bad.
yeah, it's yeah. I mean, there's houses. It's funny, before we moved here, because even though I'm from LA, I never really came to San Pedro except to go to that Fisherman's Wharf, and that had been years. So
Yep.
they gentrifying all that too.
Yeah,
And
all
so
that's changed.
when I came down here, I was like, dang, they got houses like this in San Pedro. Ooh,
Yes.
yeah.
Yes.
No, but then there's some
Insurance
shady parts
policy.
I wouldn't be living in.
Right. But it's it's like Compton. Compton
Right.
there's some good parts. Suffice to say, there's some good parts in Compton.
Yeah, there are.
So
We have friends that live in Compton. They live in a beautiful neighborhood. But
you know how
Wow.
that narrative
two,
goes.
2
But
or 3 blocks later,
yeah,
might not be. Might not
And
be
this
so
is-
nice.
and this is all great stuff too, because again, this is great stuff for Mike to hear. It's certainly good stuff for my sons to hear, or to to be able to know, because what Tracy's talking about is this is what we need to do
Mhm.
for. I mean, I can't believe that I'm gonna have to start, because I'm still working stuff out. Well, I shouldn't say still working, but my brother and I have done our due diligence with our mom, and as it relates to the trust and all that stuff concerning our house up in Altadena.
Yeah.
But I mean, here in the very near future, I'm gonna need to have the conversation with my sons
Mhm.
in terms of this house,
Yeah.
the house in California, our rental house, because we've got to be able to kind of get those things set up
Mhm.
already now while they're young. They're 20 and 18. And
Right.
so I believe
That's
that's
another
the,
show, talking about your wills and getting ready for your,
Yeah, getting
your
a trust.
everything together.
And newsflash, y'all want to hear something?
yeah.
You can put them life insurance in a trust too.
Mm.
And when you put that life insurance in a trust and do a family trust,
First off.
Yeah.
Okay, so we gotta talk. We gotta
Jackie,
talk.
get her number.
I'm gonna put my
Izzy,
email
can you
on
get
everything.
your
I
information?
wanted to look, I know we're at 5:00. I wanted to show y'all something, but I don't want to make you mad. So maybe I shouldn't show it, huh?
No,
You
show
can
it.
show it. No, show it. Show it at the after show. The after party.
Okay, yeah, I'm gonna show it at the after show.
Because it is 8
So
o'clock.
they ain't gonna, the other folks ain't gonna see this.
They're gonna be
We'll share
mad.
it with you
And you gonna see where the banks put their money.
We'll share it the next time. Well, Tracy, thank you
Okay,
so
so
very much for being with us. And
My contact information
go ahead.
is Tracy Craddock, TracyCraddock @outlook.com. So just email me.
Thank you so very much for being with us. We appreciate it.
You're
And today was
welcome.
Flashover Season 7. We're going to be on a 3-week break. We'll be back on April the 20th for Season 8. But remember, everything you heard and everything we said was our point of view. And we'll see you next time. Bye-bye.
Bye.